Hello everyone, welcome to Moneycontrol's Ideas for Profit. The company that we'll be talking about today is Dixon Technologies, which is a consumer durable manufacturer. Well, the company's performance in Q2 was fairly stellar. It was a strong performance on all fronts. Well, in terms of the top line grew by around 90% on a year-on-year basis, and the quarterly revenues for Q2 FY20 came in excess of 1400 crores. Well, in terms of the margins as well, the margins were fairly stable and witnessed a minor improvement around 10 basis points compared to previous quarter. And the operating profits also came around 93% higher in comparison to previous year. Well, in terms of the bottom line of the company, well, the bottom line surged around 160%, primarily aided by a lower tax. Talking about the key highlights from the results, well, in terms of the top line, the company witnessed a strong revenue growth across all its consumer segments. Well, in terms of the consumer electronics segment, the company witnessed a revenue growth in excess of 100% on a year-on-year basis. Home appliances as well as the lighting as well as the mobile phone verticals also witnessed very strong revenue growth in the quarter gone by. Well, the revenue growth was primarily aided by new client additions, which the company had incurred. In terms of the consumer electronics business, the company has added Xiaomi as a new customer, and that really aided the volumes in the quarter gone by. Apart from that, the company is also in conversation with Samsung for as a new client addition, and that really aided the revenue growth in the quarter two. Well, coming over to the margin picture of the company, the gross margins were higher on a year-on-year basis. This was primarily aided by higher capacity utilization as well as lower input costs. The primary reason of lower input costs is that the commodity prices have actually declined on a year-on-year basis, and that had a positive impact on the margins. However, the operating margins were largely stable because of the company has a lower share of original design manufacturing, which really had an adverse effect on the operating margins. The operating margins of the company actually came in at around 4.5% in the quarter two compared to around 4.4% in the corresponding quarter last year. Well, talking about the stock outlook, the near-term outlook of the company appears to be fairly strong as the company has witnessed strong order book from its various clientele. The company is also undertaking capacity additions across its various product lines to be able to the incremental demand on the consumer durable side. Well, in terms of the consumer electronics, the company has expanded its capacity from 2.4 million to around 3.6 million. On the lighting segment as well, the pattern capacity has been tripled in the quarter gone by, and the same should reflect in the revenues in the coming quarters. Besides that, the company is in a sweet spot on the back of the Make in India manufacturing thing, and it's augurs well for the company in terms of the long-term structural story. Well, coming over to the valuations of the company, well, the stock has seen a strong run-up in the recent months post the announcement of Q1 results and the Q2 results as well. Well, the company is now trading at around 36 times FY20 estimated earnings, which appears fairly expensive from a near-term perspective. However, the long-term structural story of the company remains intact, and long-term investors should look forward to accumulate the stock on dips. Well, that's it about the earnings review of Dixon Technologies. For more views and updates, do log on to moneycontrol.com. Thanks for watching.